Welcome to India Market Open. It promises to be a busy week, guys. Global cues are looking good this morning, but let's not forget that after a 5-day consistent uptick, Friday did see some profit taking. So quite a war between the bulls and the bears, and it will promise to be a volatile month, if not just today.
I'm saying it's busy week ahead, but what a busy weekend in terms of a lot of results coming in, numbers coming in, and you're going to see that maybe dominating the first half of Monday trade today.
And also,
more than anything else.
I think we should mention this unfortunate passing of Abhay. I think
Absolutely.
that was a little shocking. I think the banking world would have literally...
Complete condolences and rest in peace,
Yeah, but the week is very exciting because there is Fed meet. It's a week full of...
Wednesday is a holiday.
Yeah, Wednesday is a holiday, but there's a Fed meet. There is Chinese CAC-in data. There is US non-farm payrolls. And if global was not enough, of course, elections in full swing here. And
auto sales.
Auto sales, Adani Group earnings. It's going to be a really, really busy week.
So a lot to look forward to and a lot to unpack this morning as well.
And Niraj, of course, goes off on Wednesday.
Takes
a rain check on the busy week.
I get you updates from the Berkshire Hathaway.
Yes, and you can track the FOMC meet locally then.
Maybe, that too.
All right, so let's talk about what happened overnight, as in last weekend actually. Friday was pretty decent. US markets posted gains, and for the S&P, in fact, it was the best closing week since November. Likewise for the Nasdaq. Nasdaq up about 2%, and it's all about Alphabet. I mean, where Meta disappointed, or where Mark Zuckerberg disappointed, Sundar Pichai came to the fore. Let me put it that way. Alphabet and Microsoft both boosted sentiments. Alphabet up 10%, and the reason is they have very, very clear AI-focused plans and how they are going to monetize them. Something that the street liked and rewarded. So that was a big story there. PCE numbers also came in, personal consumption expenditure numbers, which were pretty much in line, slightly above estimates, 2.8% versus 2.7%. That was the estimate, but nothing alarming. And something which has helped calm fears after US GDP data late last week pretty much shocked everyone with a contraction. So the big, of course, event is going to be the FOMC meet on Wednesday. We will know the outcome Thursday morning, India time, and we'll be on top of it. So don't worry about that midweek holiday, interrupting that flow. No one's really expecting a rate cut at all. In fact, what is going to be seen is the indication of when the FOMC or when the Fed actually feels comfortable to start talking about rate cuts. Is it September this year or even further down the line? Likewise, bond yields did slip off, and not too much movement there, at about 4.66% on the 10-year. Crude has also been on the lower side. Brent was down about 1%, and we'll just pull up Asia and look at how it's opening. Has largely, at least on open, followed cues coming in from Wall Street. Nikkei won't be on today. It's a holiday there today. So Asia is looking good. The implied open, just very quickly, before we get to what the key local factors are and stocks to watch, etc. We're looking like we're opening up in the green, which is great. Just want to take you through the fund flow on Friday, because that was a bit of a rocky day in all. So DIIs bought 4,357 crores, and FIIs continue their selling spree. Will they turn round after June is what remains to be seen. But all in all, the cues, at least globally, are looking pretty good.
Yeah, just very quickly, Tamanna, on that FPI number. So Friday, of course, we saw some selling once again. But you want to note for that month of April, FPIs across equities and debt have sold to the tune of 6,300 crores on concerns over tweaks, remember, made to the India's tax treaty with Mauritius. Along with that, you've had rising bond yields, you've had higher crude, valuations probably more attractive in China. So many moving parts, and that's led to FIs actually exiting in the month of April across equity and debt. Remember, in the month of March, they had bought worth 13,602 crores across equity and debt, and 22,419 in Feb, and 19,836 crores in the month of Jan. So this is truly the first month this year, where FPIs have actually turned net sellers across equities and debt. Debt, of course, has picked up significant inflows over the last couple of months, but it seems like that could be taking a little bit of a break on back of everything else that's happening globally and locally as well.
Just one more thing I would mention noteworthy before I hand off to Niraj is the Japanese yen, which has weakened to 160 levels versus the dollar, first time since 1990. So weak flows there. Of course, so we'll get you more details on that story, why, and the road ahead. But meanwhile, focus on what is happening here. And here it's all about the results, isn't it? Largely.
All about the results. But if you just zoom out and look at the longer time frames, Feb mid, we were 22,500. Currently, we are circa 22,500. So in some sense, we've gone all over the place. But point to point, the markets have consolidated beautifully. And Samina was talking about fund flows. For the month of April, equity outflows of 36,000 crores from the FI side, and the Nifty is flat. Just goes to show how well this selling is getting absorbed. Meaningful way. 36,000 crores in a month, you would think that markets would really crack. They haven't. Month to date, we are largely flat. So largely flat for the month of April, point to point from Feb. Markets have largely consolidated ahead of the elections. If people are thinking of a pre-election rally, that hasn't at least come thus far. The other noticeable fact was that last week, guys, any guesses for what the top loser of the week on the Nifty corrected by?
10%.
Any guesses? The top loser on the Nifty.
I'm guessing.
But overall, the top loser of the Nifty, save for maybe one Kotak Bank, and which fell 10% on Friday, but otherwise, most of the other stocks ended in the green. It was a week of solid resilience, more so for the broader end of the spectrum, because the mid-cap and the small-cap indices were up 4% the whole of last week, despite the large caps not doing so well. And the other standout aspect to my mind was that Bank Nifty saw so much of volatility. PSU banks ended in the green. So much unlike what used to happen in the past, wherein the PSU banks were the first to get shunned, now PSU banks are actually showing resilience, while even when the Bank Nifty is not doing well. So that was a really good thing.
And I think, Niraj, this does tie back into FI flows. FIs generally prefer the top or the tier 1 companies, which is a Nifty 50. We've just mentioned that broader markets are the ones that are seeing outperformance. Broader market participation is largely coming in. Broader market participation is largely coming from DIIs. And if you look at some of the funds across the broader market, so your small cap and mid cap and momentum funds have actually seen a pretty significant rise in participation. So while that benchmark looks flat, there's enough and more activity that still remains in the broader.
Even on the benchmark, you had a good recovery. On the Nifty also, you had a good recovery over the last, I would say, 5-6 trading sessions and more. So we'll have to see what is set up even further. So an interesting day of trade, but it's all about the results.
But just before we move on to the specific stocks, just rounding off the trade setup. So from sectors to watch, metal and pharma stocks seem best positioned to continue the up move, and just scanning the results piece, preempting what Tamanna was trying to say, not just for the day, but you look at Q4 thus far, the 5 sectors that have stood out in terms of great performances: solar companies, asset management companies, breweries, hotels, and real estate. These 5 collectively have shown the best performance thus far. You know where the buck might follow is where the results are coming up and the commentary is positive. Watch out for companies within these spaces. They seem to have done really well thus far in the earnings season.
I love how you can read my mind.
Perils of working together for so long.
Nevertheless, I think the whole slew of bank results over the weekend is also going to be very interesting. And I know some of them are on your radar as well. But from a Yes to an RBL to an IDFC, apart from, of course, the big one, ICICI Bank.
Indeed. But just a quick check on implied Nifty before we jump into that. It looks really good this morning, actually. About 190 points higher. Okay, now it's back to 82. So I think that's a fair expectation. The Nifty is expected to get a decent gap up. 22,500 will be important. For the bulls, of course, 22,300 is an important level of support. And on the upside, you've got enough and more call writing that is being seen. at levels of 23,000. So that's going to be the range. Interesting in terms of what we will see. Volatile as well, lots of big earnings, and I'll start with a few to begin with. I'll take ICICI Bank. The numbers were largely in line with expectations. They've seen a 17% growth year on year in terms of net interest income. In terms of deposits, deposit growth was healthy. Provisioning has seen a fairly big drop of 55%. Net profits have also grown. Margins, though, have declined quarter on quarter for ICICI Bank. Expectation is that margins may remain under pressure for the next few quarters due to repricing of deposit that is still not taking place at ICICI Bank. Asset quality for the bank has seen an improvement. Provisioning has dropped as well due to reversal of the AIF provision, and the quantum of that is about 116 crores in the quarter. The bank is recalibrating its growth targets for the non-secured piece. But deposits growth were healthy at 20% YOY versus the 13% system deposit growth that we've seen across banks in the country. Most brokerages remain bullish on ICICI Bank with a buy rating. A couple of things that they're watching out for is attrition among senior management and maybe some impact on growth due to macro conditions. But largely speaking, good numbers in line with what the street was expecting. Brokerage is still constructive on this one. We'll keep it with banks for a minute before I go to HCL Tech. Yes Bank reported numbers, and their numbers have more than doubled on the top line. But let's not get too excited. The growth year has been led by higher income and lower provisioning. Core growth was only about 2% for the bank. Asset quality has also seen a little bit of an improvement. But what we've seen is that in the unsecured loan book, there have been some slippages. So that continues to be a bit of a worry for Yes Bank. Operating expenses were also higher. We'll try and understand from the management of what led to an increase in Opex. And of course, net interest income has also stayed largely flat. In terms of commentary, what stood out was the partnership with Paytm, payment service provider. The UPI market share now, Yes Bank, we believe, as management has indicated, stands at 38%. So we'll watch out for Yes Bank and see how the markets take the numbers. Largely flat in terms of core growth. Of course, the number that we see on the top line could be deceiving because it contains a pretty significant chunk of other income. Well, the other one that we have on our radar this morning is one of the last ones from the larger IT companies that's reported numbers. And actually, it's a good set of numbers for HCL Tech. And Niraj, of course, caught up with the management, so we'll get some more perspective on that shortly. But largely speaking, I guess he says, no, the numbers were muted.
They look pretty bad.
Richard did talk to a couple of brokerages and they said they weren't too bad. They've seen a solid revenue guidance. What we've seen is seasonal factors that have impacted their numbers. Attrition was also, the hiring was better than expected. TCVs have seen an uptake.
Your margins are down.
The deal wins are very good.
Exactly.
Deal wins are good, but
revenue guidance is not so bad.
No, so relative to what they did as an exit rate, the revenue guidance, people are saying 3 to 5 is actually very muted.
But you compare it to the likes of an Mindtree or an
No,
Infield.
relative to the industry,
They've
it's
done
the
better
highest.
than the
But
industry.
what they've done for FY24 and the valuations that they're trading at, I thought the one that 3 to 5% is a bit muted, and not
what
only was
did they guide
Q4
for last quarter?
Sorry?
What did they guide?
I don't know the quarterly numbers, but the annual basis, they will now repeat what they did in FY24. And based on the exit that they had given in terms of what they mentioned at the end of quarter 3, this guidance to a lot of people left a bit to be desired, part 1. Part 2, quarter 4 was weak and quarter 1 will be hit by offshoring impact. So you will see a weak quarter 1 too.
But keeping in mind what's happening globally, the uncertainty, the non-committal nature of clients, are we looking at it relative to what the rest of the sector is doing? And I think that's what's most important. HCL Tech could be the leader, but the fact remains macros have changed.
Yeah. So then it's bad for everyone. But the fact is that
but I feel like they've done
down.
better than the rest of the others, right? I think that's probably one way to look
Guidance,
at it.
yes. Performance, no. Let's see how it works.
Hiring. They've also very clearly indicated that they'll continue to hire going into next year. TCV has seen an uptake. In terms of discretionary spend as well, they've said this is client-specific, but they've actually seen an uptick in discretionary spend. And that again stood out for me because every other big IT company has been seeing operational upticks, right? Cost operational efficiency.
Can
no
I
one
say
really has seen an uptick in discretionary
unpredictable because
spending.
you remember it's unpredictable on how the street will react. I would say because remember Telecom. on the face of it, very bad numbers. But one comment from the new boss, from the new boss, saying that they expect that he's very strong in terms of guidance and has a positive outlook, changed the street's mood. So I think it's a bit of a hazard to guess how the street will respond.
Wage hikes were also done. Senior management who was skipped last time around also went through a pretty solid wage hike. So we can choose to look at this glass as half full or half empty. I do think while they might not have done as well as they are usually used to doing, the fact remains you compare it to, and I mean these are much smaller companies, but a Wipro and Emphasis, those numbers, those commitments were much weaker and the markets rewarded those companies. I caught up with Emphasis and there was no sign of things looking great, but the markets gave it a 5%
So Wipro was positive because it's a honeymoon period for Srinivas Pallia.
Tech
Mahindra again. Mohit Joshi has given his whole plan. He's going solo. So I don't know what the street really looks at. We'll have to
wait and see. But I think on the face of it, we'll try and see what brokerages have also made of this. But Niraj for now is not impressed. Tamanna is sitting on a mix on the fence here. On the fence.
No, I think HCL Tech will have a negative opening today is my take. If I have to pick one side, at least initially, I don't think it's going to have a great opening. But then we'll wait and see. All right, more of that actually for a Maruti as well. And here is another one for fence sitters, because on the face of it, the numbers are not bad at all. You had a 48% jump in net profits, revenues up 19%, EBITDA is at 40% year on year. All of this, or most of it I should say, coming from their SUV sales that have zoomed, but their small car sales went down about 11%. And you'll hear an excerpt of that conversation I had with R.C. Bhargav at about 9 o'clock, a longer one later in the day. They are focusing big on CNG, 6 CNG launches next year. What the street might not really like are the margins. The margin expectation was a little higher than what they came in at 12.3%, so significantly more year on year. But the expectation was penciled in a little higher. The sense from a lot of brokerage notes out in this, Nomura, HSBC, Motilal Oswal, is that considering all the tailwinds, the stock could have done better. It is also now priced quite richly. So Nomura, for example, sees a downside of just about 1%, remains neutral with a target price of 12,523. What they see as the headwinds are now, you will have to give in discounts because inventory is sort of filling in, and market share could also come down. Motilal Oswal on the other side is positive. They reiterated buy with an upside of 16% at 14,700. But you might see a bit of pressure on Maruti, at least as far as opening is concerned, although it's a solid set of numbers for a company in that size, for the largest passenger vehicle maker in India. IDFC First is another one, and so many bank numbers. IDFC First, I think, is going to do okay. Their NIIs are 24% up. Net NPAs have come down. Gross NPAs have also come down. Net profits are down, though 9.8%. Most brokerages, what they're saying is that numbers are broadly in line. The concern is high operating expenses, and margins have also contracted Q on Q by about 7 bips. But deposit growth is healthy and CASA ratio is a positive. Vaidyanathan has got an extension. The street might see that as a positive. The third category, which I think you might really see some action, is small finance banks. And watch out for an AU small finance bank or an Equitas, because the RBI has now issued a sort of a guidance, a map, an instruction set on voluntary transition of small finance banks to universal banks. So this is an opportunity for many of these to scale up. They've given their set of eligibility criteria. They need a minimum net worth of 1,000 crores at the end of previous quarters. And of course, there's different criteria which have also been set out. So you might see some action in small finance banks as well.
Yeah, certainly watch out for two of them, AU and Ujjivan, the ones which are eligible for the transition to universal banks. So in some sense, watch out for out of those 8 or 9 out there which are eligible, AU and Ujjivan. And Ujjivan depends on whether in their quarterly numbers, their GNPAs and net NPAs come below a particular level. So I think two interesting names to watch out for from that list. the three names that I have, two positives, one negative. The negative one is likely the stock of the day for all the wrong reasons. BSE. SEBI has asked BSE to pay a regulatory fee on the annual turnover fee, considering notional value in the case of the options contract. Apparently, since the introduction of the derivatives contracts in June, BSE has been paying the regulatory fee on the annual turnover, taking into account the premium value of the options contract. Per norms, the fees need to be paid on the notional value, supposedly very high relative to what they have done. In addition, apparently the fees paid to the regulator for FY07 was a quarter instead of a full year, and therefore the exchange will now pay the differential amount in fees along with 15% interest for every year. So the computation has to be calculated by a notified chartered accountant. BSE has to pay this within a month. Now, suppose if this can't be challenged, let's assume it is as is, the order goes as is, then one of the brokerage's notes or sales note that I read, and therefore I'm not quoting it, seemed to suggest that it could be an earnings cut of 40 to 50%. We do not have the exact handle on this, but all we can definitely say is that this is a negative. The stock will have a slam dunk today and open. Let's wait and watch what happens post that. We'll try and get you as much intelligence as we can during the course of the day, but suffice to say this will start off negatively.
Yeah, and it's had a good run last week.
Yeah,
so I guess we shouldn't be complaining too much. But
no, but certainly.
Yeah, it's going to be a weak stock.
This is a fundamental hit, though.
Yeah, there's a big hit, and certainly will react. Two more stocks, Adani Enterprises. Standard disclaimer, the Adani Group owns NDTV. You're watching NDTV Profit. But the Adani Connex JV has secured a fundraise of up to $1.44 billion for green data centers. Now, this should work positively for the stock. Watch out for this one in the session today. Hasn't quite moved. Does this move the needle a little bit? Let's wait and watch. And from amongst results, the one that really stood out was Shakti Pumps. I mean, what a blowout set of numbers. Revenues up 3x. And okay, this is Adani Enterprises, of course. Let's move on from Adani Enterprises and move on to Shakti Pumps. Shakti Pumps is the third stock that I'm mentioning. The stock hasn't had the best of runs recently, but look at the results. Revenues up 3.3x, big uptick. Margins jump, as a result of which the profit after tax shows a very unnatural rise. But the beauty is, on a trailing 12 months basis, which is FY24, the stock trades at 25 times. It's not egregiously expensive for a company which is showing some great results. Let's wait and watch if this one reacts in the session today.
I have just one quick one, which I know you were quite excited about, and that's Apollo Hospitals. It's going to be a big one to watch out for in terms of development outside earnings this morning. Apollo Health Co., which is a subsidiary of Apollo Hospitals, on Friday evening released a a report stating that they are entering into a binding agreement to raise equity capped to the tune of 2,475 crores from Advent International. In addition to this, Apollo 24/7 has also entered into a framework agreement to merge Kimet, which is India's leading wholesale pharma distributor, in a phased manner over the next 2 to 2.5 years. We will be talking to the management on the channel at 10 a.m. and get some more details on this, but the counter could be one we should be tracking in early hours of trade, a gap up to quite an extent.
No. So the problem is that this fair valuation, the EV valuation, is actually coming at $1.75 billion, significantly lower than what analysts were estimating. For all you know, this might actually have a binary reaction. So Samina, you may be right. The street may be happy with the deal, but the valuation is so low that the stock may get corrected.
So they're going to have to sell cheap, essentially.
Yeah, that seems to be the case. Yeah.
All right. RBL, I thought we should just talk about, since we're talking about all the banks.
Solid set of numbers.
Solid set of numbers, and more potential, I think, to see a good up move. We focus on all the ICICI banks and yes banks, but RBL might sort of steal the limelight here in opening at least. NII is up 18%, NPA is down, net profit up 30%. So I'll go through it quickly, but RBL is one definitely to watch out for. Aditya Birla Sun Life AMC was the other one, and you track this space quite closely, Samina, but I thought on a relative term it seemed okay. Yeah. Net profit looks good at 206 crores. Total income as well was up about 33%. But compared to the kind of numbers that we've seen from some of the other players, Aditya Birla Sun Life AMC is okay, I would say. Sort of a medium tepid kind of a response is what you could see. I'd look out for Motilal Oswal once again as well, because their numbers came in right before close. On Friday, they had a big up move, tempered down a bit, but that's a solid set of numbers. And we're going to speak to that management head as well.
Yes, just two more large names from the SBI family. So SBI Life was a solid number relative to what was anticipated, and the HSBC note kind of lays that out. They have a buy with a target price of 1790 on SBI Life. They say the large part of the growth was driven by channels outside of the proprietary channels, which is a positive. But more importantly, their call is that healthy APE growth, sequential margin expansion, lower costs, improvement in persistency were key positives. They estimate stable operating performance with an APE CAGR of 16%. They're valuing the stock at 2.2 times FY26 EV per share. So watch out for SBI Life and watch out for SBI. Okay, and watch out for SBI Cards. This is the other one. Weak. I mean, the numbers were good, but for SBI Cards, NIM contraction, lower new card issuances have outweighed the healthy spend growth. The credit costs and the write-offs inched up. Absolute GNPA and net NPA are at 12-quarter highs. And the card addition and multi-quarter lows may impact FY25 spend growth. So do watch out for SBI Cards. Could have a bit of a corrective move today. So that's the other one that I thought was important as well. Okay, so that's the long and short of stocks. Let's try and talk about, it's election season, and Tamanna briefed people about what the second phase would do on Friday. What I'm trying to do is take it a bit further and talk about things which might have an impact, Alex, based on what brokerages are saying.
Absolutely, and in fact, we're trying to peer into the not-so-distant future, but it's still very hard to identify how things will move. We're talking about the moves post-elections, right, and what brokerages anticipate. And we're starting with a conversation on how the options patchwork kind of builds together, right? So let's start with that. And I must say that it's a bit of a cliche to start with. History does not repeat itself, but it sometimes rhymes. Maybe that's something that could happen this time around as well.
Yeah, so just a tale of a few charts, Alex, based on two reports that came in from JP Morgan and Jefferies. So one, the implied move for 2024 elections versus 2019 and 2014, and the chart will come up on your screen, and that tells you how this time around the scene seems to be relatively muted compared to what we've seen in the past. Now, don't quite know if this has got to do with the belief that this time around it's a more certain outcome than what it was in the past. So therefore, possible to compare what 2024 will show versus what 2019 or 14 will show.
And the global setting, could that also be, of course, we're attributing quite a bit to the general elections and the outcome therein, but I guess there are more significant global events that are taking place now than there were in 2019, certainly.
Yeah, in which case, if anything, Wall should have been higher, and everything else notwithstanding, things should have been volatile more, maybe. Yeah. But quite interestingly, and the comparison is interesting from JP Morgan, right? I mean, this is a note that they came out with, I think, on the April 18th, if I'm not wrong. Largely constructive, but they're saying that the walls don't seem to suggest that something dramatic. Then it's just the MSCI India relative return to MSCI Asia ex-Japan that has typically been seen during this period, Alex. And again, this is a chart that will come up on your screen, something that Jefferies laid out. And it's interesting how they note what some of these returns seem to imply. And it's not that relative to Asia ex-Japan, there has been a rapid rise of sorts that is coming. And therefore, does it set the stage for maybe a post-election rally?
Interesting. Okay. So, but then, let's talk about also the sectors, because you've highlighted that as well, and how each of the sectors has moved in the 6 months after the 2019 elections. Is there any possibility of that repeating itself?
Yeah, so the only thing is, it's great to look at the past, right? 2019 saw this happen. Was the narrative and the promise made post-2019 different than what it is right now? I don't know what your thoughts are. I don't know what everybody else, viewers' thoughts are, but just the it almost seems to be a done deal that everything related to manufacturing, infrastructure plus energy seems to be, and defense maybe seem to be the buzzwords this time around. So yes, interesting to note that Jefferies is putting that out as the key themes that did well. I mean, and energy had a great run then too. Can energy have a good run right now? That's one key thing. A clutch of stocks didn't have a great run then. Do you want to see an encore, or do you expect to see an encore this time around? But it's an interesting data point that people should keep an eye out for.
And that kind of is borne out by the kind of capex spend that has played out over a period of time.
Yeah. In fact, so the JP Morgan note talks about India's climbing capex,
right?
And it'll be interesting to see if indeed that move continues and whether private capex comes to the fore. I think that will be the other interesting piece.
How important is the texture of that capex, though? Because we've seen certain spending of, and you mentioned energy. There is highways growth. Railways was a major thrust area, and also, what else was there? There was. Railways primarily.
Yeah, railways
and defense. Sorry, I'm missing defense. Yeah. I knew I was missing one key element.
The only key thing is that does private capex in a meaningful way come to the fore?
Right.
Part one, and does that capex benefit banks, because hitherto companies are shying away from taking bank loans. But I think the chart showed a lot, and the question only is that can it continue further. So
you've spoken about China plus one here, and the idea is it going to continue to benefit certain sectors? Is that really a big talking point?
So manufacturers are talking about that. So for example, we spoke to Syngene and Lotus, right? A small example, but I'm just saying CDMO. And people are talking about how the Biosecure Act in the US leads itself definitely to a China plus one scenario wherein spends on CDMO could increase and some of these sectors could benefit materially. So that's CDMO. But beyond that as well, we've heard chemical companies talk about how European companies are wanting to outsource more from other destinations aside of China. Much spoken about, can India's manufacturing step up? Can the policy promise step up to say that we'll give you the infrastructure and everything, just come and manufacture in India? PM Modi seems to be the forefront of saying that manufacturing is going to be the buzzword post-elections. Let's wait and watch.
And there's a lot that is happening in the undercurrents, right?
Yeah.
We saw headlines this morning of Tesla CEO heading to China just a week after he cancelled his India trip.
Yeah.
And of course, China opening its arms and saying, hey, come and invest here. So they're not going anywhere.
No, not at all.
The thing is, let's see if India can capitalize on that. And the last aspect I think you've spoken about is per capita GDP to approach $4,000 by 2028. That's quite significant.
Yeah, and again, not something related to elections necessarily, but certainly discretionary.
A step in the right direction.
A step in the right direction. Discretionary spend could go up. So watch out for all the players there.
All right, so there you have it. Of course, we're not saying that we know exactly how things will pan out. Nobody does. If we did, well, other people would, and people would make a lot more money than they're making right now. But having said that, let's set you up for the rest that you need to know before the start of trade, and that's coming up after this very quick break.
Hello and welcome back. You're watching India Market Open. We're gearing up for a pretty volatile week of trade. Remember, the end of the April series was actually pretty good, but the Nifty over Friday gave up some gains. And this morning, of course, on back of strong global cues, we're expected to get a gap up in terms of trade. But let's not forget that the bears still do have some control on the street, even at this stage. Well, that's the GIFT Nifty indicating to a 90-point uptick. 22,500 is going to be an important level for the street to track in today's session. In terms of what the Nifty futures are indicating, the Nifty futures are trading at 136 premium with a 10% decline in open interest, very clearly indicating that the bulls are a little cautious at this stage to initiate fresh long positions, and of course the rollover picture doesn't look as healthy as you'd have liked it. In terms of bank futures, remember BankX was a star all through the end of April, 6 straight week of gains. This is despite the likes of a Kotak actually declining quite sharply. Nifty bank futures also up about 178 points. Open interest is down about 6% is what we are picking up on. In terms of the call puts spread, the expectation and the implications are that 23,000 continues to see maximum call OI. That's followed by 22,000, 22,600 and 22,500, indicating that's a key level of resistance that the streets will be facing in terms of the upside. On the downside, where we've seen activities 22,000 and 22,300 and 400. These are the levels of the markets are seeking support. 22,000 for the most part of April has seen maximum put open OI and continues to be a rather important and significant level of support for the street. Much lower down, but before that, of course, you've got 22,200, 22,300 and 22,400 that we are tracking. In terms of a trading range, 22,400 and 22,500 will be a critical range that the markets will be watching. We are also expected to face enormous amount of resistance around levels of 22,500 and 22,600. That's what we have in terms of the Nifty 50. But remember, rollovers have been lower than expected. FIs have been selling the street. You've got a whole bunch of important macro data points as well that the street will be watching out for. So all of that will keep aggressive traders on the sidelines. And the big event in June is what could ensure that May is going to be a month that will turn out to be fairly volatile. We have with us Milan Vaishnav joining us to take us to his F&O strategies. Milan, let's talk about the index first. And Friday did see some profit taking after 5 pretty good days in the session. As we see it now, 22,500 to 22,600 is pretty much where we are seeing maximum call OI. So resistance around those levels. How do you trade the street? How do you play this range?
Hi, good morning. I see multiple things that are likely to happen this week. First of all, we are once again having a truncated week with Wednesday being a trading holiday. And so far as Nifty is concerned, I see it continuing to stay within a broadly defined range of around 22,900 to 23,000, acting as resistance on the higher side, 22,000 playing as a support. But along with that, I also expect Nifty Bank to improve its relative performance against the Nifty. So right now, we can see a strong breakout in Nifty Bank if it is able to move past 48,600 levels. But even if that is not happening this week, it is in a very clearly defined trading range of around 48,600 on the upper side and 47,000 on the lower side. So as compared to Nifty, we will find more trading opportunities this week in Nifty Bank. Whereas I expect Nifty to stay largely in a trend while continuing to resist to 22,800 to 23,000 zone.
In terms of a strategy, Milan, how would you play the Bank Nifty and the Nifty?
I would rather play a short strangle with Nifty because I expect Nifty to stay in a range, whereas we can expect some movement in Bank Nifty. So I would leave off Bank Nifty, but I would rather play a range in Nifty. I would recommend a short strangle by selling 2nd May expiry 22,800 call and 22,100 put and realize a total premium of around 51 rupees. That is a little over 2% yield on the capital deployed. And as a measure of risk management, we can move out of this position if Nifty violates 22,050 on the lower side or moves past 22,850. So I expect this range to sustain during the week. More so when Wednesday is a trading holiday. If someone survives in this trade for at least 2 days, they will be able to realize the bulk of the premium out of the total premium that we are speaking about.
Milan, what about ITC? You do expect the stock to see a little bit of a price rise. What is the strategy on ITC for the series?
Yeah, this strategy basically comes from a top-down view where I'm seeing Nifty FMCG index showing a strong improvement in its relative momentum against the broader markets. So among this, I also expect some overall defensive playing out in the market. So with that in mind, I recommend ITC bull call spread. One can buy May 440 call and sell 460 call. Pay a net premium of around 7.3 rupees. Maximum profit that we can expect here is around just over 20,000 rupees, and max loss that we can suffer is around 11,600. However, we can still keep this maximum loss further limited if we keep a stop loss of ITC slipping below 428 levels.
Right, thanks for that, Milan. That's a strategy coming in on the Nifty and ITC, expecting a little bit of a price rise on ITC and expecting the Nifty to trade in a range. Well, Tamanna, with that, it's back to you.
All right, and focus now on Motilal Oswal Financial Services. Numbers were out Friday, just shortly before trade, and a really interesting set of numbers. Reiterating or resonating the kind of excitement in the capital markets, and in a sense this is a proxy for it. Shali Bhadra Shah, CFO of Motilal Oswal Financial Services, is with us this morning. Mr. Shah, very good morning. I hope I pronounced your first name correctly. And the street is really, I think, excited already about the numbers. We saw that in the last few minutes of trade. If you can take us through what has really worked. I mean, your net profits up 334%, total income up 108%. Give us a sense of your margins and where the focus now is.
Yeah, good morning. You pronounced it well. Really, from the overall performance of our entire FY24 and especially even Q4 FY24. So actually, we have seen a very sharp sequential uptick. In fact, every quarter on quarter, we have seen the uptick in our revenues and profitability. And even across each segment of our business, whether it is capital market or whether it is asset management, wealth management, private equity, we've seen a very good rise in the numbers over last, in fact, 8 quarters. And we expect the momentum to continue strong. So overall, on the growth side and margin side, so our profits have actually grown in Q4 on a year-on-year basis by 66%. Our quarterly run rate of profit has now touched 495 crores. That's almost 500 crores of quarterly run rate of operating profit. And the total profit also has grew sharply for the entire year. The operating profit has grew to 1,535 crores, which is up 38%. And including our treasury, the total profit is almost up by 200% to 2,600 crores for the entire year. So in a runway of sharp uptick, we also see margins going up in the business. And you highlighted about margins. So margins have gone up by 400 basis on a year-on-year basis to 55% on a PBT margin across our operating businesses.
What is your market share looking like right now? Is that something you track, and is it possible to track, because it's a fairly fragmented space as well? But what is the kind of market share, and what is the outlook for market share, Mr. Shah?
Yeah, so we definitely track the market share. So our overall market share on the cash market side stands at 8.2%. That is our volume market share. And on the F&O premium side stands at 8.7%. The market shares, even on our asset management business, have gone up, given that we had a very robust performance across all our strategies, and 95% of these products have outperformed the index. Even the market share on gross sales, net sales, and SIP have actually significantly gone up on a year-on-year basis.
Guiding for in terms of market share, or what is the sort of aim?
Our aim, so these are volume market shares. Again, we look at also revenue market share, especially in capital market business, where we are already at around 11% market share. Our aim is to certainly grow this market share, and we are aiming for almost 100 to 150 basis uptick again in the market share, given our strong uptick quarter-on-quarter basis.
Right. Hi, Mr. Shah. This is also Samina joining in. Just looking at your numbers, YOY, your net profit is up over 300%. You've recorded a profit of 724 crores versus 166. I'm guessing there's a significant other income here. I mean, could you want to break that number for me? And also, total income is up 110%. I'm guessing there is an element of outside core business.
Yes, so actually, Motilal Oswal Group is actually operating into two engines. The first engine is the operating businesses. The other engine is our treasury book. The operating businesses, as I spoke about, has shown a very sharp uptick of 66% growth on a YOY basis. The treasury engine has also shown a very sharp uptick. So while it is a mark-to-market on our investments, which we do on a quarterly basis in our treasury book, which has predominantly equity investments in our own products. So that has actually uptick by a significant amount, which has led to growth of the entire total profits. So these are the two matrices, both of which have actually gone up in the current year.
And that brings me to my next question, Mr. Shah. If this is, 66% is coming in from your core business, the rest of it is on back of the gains made on treasury income. Now, we all know that that's also very transitional in nature since it's M2M. Guide me now on basis of what's already happened. Where do we see growth coming in? Because I don't know how dependable would that treasury income really be, especially for a capital market player like yourself.
Yeah. So definitely. So while we track our operating profitability metrics, that is our growth metrics that we strategize and control. But on a treasury, certainly it is driven by market and the investments that results into IRR. So far, we have generated 18% IRR on this treasury investment book. This book stands at almost about 6,500 crore, which is invested out of our free cash flows and net worth. And this book certainly is subject to mark-to-market, as I said, on a quarterly basis. So it could be volatile, but however, we track the IRRs, and as the idea is to improve the IRR on this book, which would result in the uptake in the overall profitability for us.
Right. Also, looking ahead, Mr. Shah, where is growth expected to come from? How many more folios have you added in this quarter, and what are you guiding for in the next quarter? or FY25? And also, in terms of growth, is it the product business that is seeing participation or increased traction? Is it the wealth business, which I know a lot of your peers have also been focusing on, because that is sticky clientele, if I can say that, your AIF, and also your platform business? So what really will be the key growth driver going ahead? And even if it is product, have you increased your network of distribution to help push for those products, maybe increase payouts? I'm not sure what's happening there.
Yeah. So actually, I have the number of SIPs that we added. So we added actually 1 million SIPs in the last financial year, 23-24. So that's a significant uptick in the total number of SIPs we added, and our SIP market share has also gone up. And we expect, because in our asset management business, so we've seen very robust flows over last few quarters coming in. We did almost net flows of over 5,000 crores and gross flows of 17,000 crores in that business in FY24. And we expect this number of gross flows to double in the coming financial year on the back of our strong performance across our products. So we'll see a lot of growth coming from our asset management business. And even in terms of our wealth business, so while we had been investing in our RMs continuously over last 3 years, so even in our wealth business overall, we added, in fact, 170 plus RMs in last financial year. So this ramp up of RMs would result into more better productivity and bring back our margins in the wealth business, from where we expect strong growth. Similarly, on our AIF front as well, AIFs, so we launched actually our 6th real estate fund, which did the first closing, which was higher than the third fund's entire closing. We did the first closing at 1,250 crores, and we are aiming for our 5th growth fund in our private equity business in FY 24-25. So we believe we have enough and stronger growth levers in our asset and wealth business in the coming financial year.
Right. Very lastly, Mr. Shah, I take your point. You will increase, of course, you go on aggressively high RMs, and that will help in terms of spreading your wings. But that will come in at a cost. Would it be fair for me to assume that FY25, if it's about gaining market share and increasing your top line, could come in at a cost of a little bit of profitability? Because a lot of these RMs will only be accretive about a year out, I'd imagine.
So actually, this story of addition has been happening over last 3 years. So we believe that the incremental hiring will be very strategic now, and it will not have incremental cost impact. In fact, we've already seen the margin uptick happening over last 2 quarters in asset and wealth businesses, and we believe that there is a lot of operating leverage which will now start playing in this business in the coming year too.
All right, thank you for that, Charlie Bhadrashah, CFO of Motilal Oswal, on their stellar set of numbers. He sees that continuity going. Thank you so much for speaking with us. Another Shah joining us, apart from the one on my left. Sudeep Shah, Deputy VP, Head Tech and Derivative Research at SBI Cards Securities, with us this morning. Sudeep, very good morning to you, and great to have you on NDTV Profit as always. Let's start with the indices first. So many stocks to talk about, but let's start with Nifty, Bank Nifty.
Good morning. See, what we are seeing in terms of Nifty is like on Friday, Nifty had a slight bit of a negative momentum on its side, 0.5% negative close. But week on week, if we see, it was still 1.5% positive close. And more than the Nifty, it is the sectoral indices which are right now in focus. Like if we say capital goods, consumer durable, CPSE, pharma, Nifty PSU. So all these, we are seeing momentum in individual stock-specific action as well as these other indices rather than Nifty and Bank Nifty. So we expect Nifty to trade in a range between 22,250, 22,300 on the downside, where the 20-day exponential moving average is placed. And on the upside, it has its resistance around 22,600, 22,650. Even if we see the derivative data now, the option open interest is quite interestingly placed. 22,500 and 22,600 call writers are quite active, while on the put side, 22,400 and 22,300 put writers are quite active. So I feel overall Nifty is going to be trading in a range between 22,250 on the downside and 22,650 kind of levels on the upside. Now, similar structure is there on the Bank Nifty as well, because if we see the kind of underperformance that in the last week Kotak Bank, IndusInd Bank had seen, and the expected outperformance for ICICI Bank and Axis Bank, so kind of it nullifies the entire negative momentum of these two banks, which we are expecting Kotak Bank and IndusInd Bank to underperform, and HDFC Bank is kind of on the sideways momentum.
Got it.
Overall 47,700, 47,800 is going to be a strong support on the downside.
Okay. Sudeep, what about specific stocks for the day?
Specific stocks, the first stock that I have on my list is GMR Airports Infra. Now, this stock has given a breakout post 26th February. Now, post that, it was trading in a range between 75 and 85, and we've seen a strong breakout on the upside backed with volumes. And the stock is now back to its 20th February swing high. So I feel here the kind of momentum on the daily, weekly, and monthly charts are quite supportive. And I feel this could be bought with a stop loss of 86 on the downside and a target of 98 to 102 on the upside. The second stock that I feel could do really well in the next few sessions is Engineers India. Now, there was a prior uptrend since October 2023 to Feb 2024, and post that this stock also went in some kind of a consolidation and profit booking. It took support at its 100-day moving average, and once again now it's showing signs of a stable rebound. So I feel from the current levels, Engineers India could also be bought with a stop loss of 228 on the downside and 250 to 255 targets on the upside.
All right. Deven Choksi also with us, MD of DR Choksi Investment Managers. Deven, great to have you on the show. Very good morning to you. First thing that we want to know from you is all about BSE. Now, this regulatory sort of headwind looks quite worrying on the face of it. What is the kind of impact do you think? And the fact that SEBI is coming up with fines for BSE from quite a few years ago. So in a sense, retrospective. Do you think that this is going to have a huge impact on BSE? And I don't just mean, first thing this morning.
Good morning, Tamanna. Well, I think difficult to quantify anything at this point of time. One would like to probably, I think, hear and listen, I think both the sides probably. Maybe I think the BSE deserves the chance to be what we call to be heard on the subject. And till that point of time, I would probably refrain from putting any viewpoint at this point of time.
Fair, we have reached out to BSE and their response is, and I'm quoting ad verbatim, no comments. So we want to hear from them. But the fact is that investors this morning and our viewers will want to understand what happens to a stock that has zoomed to such a large extent. So from that point of view, Deven Bhai, what is your advice to our viewers this morning who are invested in BSE or interested in BSE?
So I'm pretty sure, I think having said that, I think would like to reserve my comment till the time we hear from BSE. I'm pretty sure on one aspect that the exchange definitely, I think, will have their own versions to talk about. And I think they may probably take time to build a narrative and they communicate back. They being a listed entity, certainly they know that I think they have to communicate and keep their investors informed about the subject. So from that perspective, I think one will have to stay put on taking any speculation at this point of time on the subject. How much the impact is, what is the quantum, etc. One is not probably sure at this point of time. So I think one would like to reserve the view at this point of time.
Okay. I'm sure a bit later on, Meega is going to come and talk about this. But the IIFL note, for example, on BSE speaks about how they expect the stock to open a gap down. The target price of theirs has a 20% downside to the current market price. And they maintain that whatever cautious recommendation. And they expect the stock to consolidate post the correction. Most of the brokerages, I would suspect, would have a negative view on this one. So keep an eye out for BSE as being that one key stock of the day. Deven, good morning. This deal that has happened between Apollo Hospitals and what they've done. Now, there are conflicting views coming out there on the valuation at which it has been done. Some brokerages are constructive. Some sales notes are saying that it is being done at a much lower number than what they had thought. What is your sense on what the impact on Apollo could be like because of this development?
Well, I think again, Niraj, good morning. Again, I think the same viewpoint out here in a different context, that I have always believed one thing, that unless you make the deal a little bit more sweetener, which in this case I think they have tried to do, the investors at large I think will not be buying into the stock at an expensive valuation. The business of this company has been putting at a fairly good valuation. And in such situation, when I think you're making a deal, I think you will have to probably leave something on the table for investors. That is what my take would be. However, I think one will have to go into the detailed matrix of this particular deal to give a judgment on the subject. But I understand one thing, that I think they have kept, I think, probably something on the table for the investor in this particular deal at this point of time.
Quick word from you, Devin, is on now HCL Tech, because this was a bit of a debate on this table internally this morning on whether the numbers will be seen in poor light, as you know, on the face of it, the top and bottom line is a miss, or you will see, you know, in relative terms better than others. Do you have a view on HCL Tech?
Yeah, once again, I think the company remains pretty strong on the front of different businesses. They're staying focused on the BFSI space and wealth management space. I think that is also suggesting that they want to probably, I think, tap the market in a very more systematic manner going forward as well. Compared to what TCS and the Infosys have been, I guess I think this company has been slightly more steadier, and even compared to Wipro, of course, much more steadier as far as I think the outlook and the numbers are concerned. But all said and done, I think most of the frontline companies are not going to get enough amount of thrust from the market, largely because of the fact that I think the growth in the business that they are talking about on the size of balance sheet is comparatively smaller to their peers in the mid cap and some of the, not mid cap, but not small cap, but I think some of the smaller mid caps, as I may want to name it as. They are relatively showing the better amount of growth prospects compared to, I think, the frontline tiers.
Okay. You know, another company in focus is definitely Maruti. It was a swift March quarter for Maruti Suzuki. Net profit soared 48%, but some concerns on margins. I spoke with R.C. Bhargav of Maruti and asked him how he saw the future rollout.
You know, the commodity prices have remained benign this year. Our volumes have gone up because we had added new capacities. The exports have been going up, and the foreign exchange situation has remained favorable. And this year, this is something which is not widely known, we had the maximum number of suggestions from our employees. We crossed 1 million suggestions which were implemented, and they gave us a profit of another 750 crores or so because of these cost-saving efforts. So all these things came together, and the result was what you have just mentioned.
Let me just talk about your margins. While, of course, the overall numbers look very robust, I wouldn't even say concerns, but I suppose higher expectations perhaps on margins, which have come in at 12.3%. I believe in the con call, you know, the company has also talked about a one-time impact. Can you elaborate on that, Ms. Bhargav?
See, margins is something which I always feel a little hesitant about commenting, because many factors which determine margins are not within the control of the company itself. And if margins are gone up, you have to look at what's happened to the yen, the dollar, the euro. You have to look at commodity prices. You have to look at the non-operating income. So many factors which we don't control. And so it's good to see margins go up. What is more important is the efficiency of operations within the company, the factors which we control. I think the best any car company can hope to do is that in the areas which are within their control, how have they managed those areas? If the costs go up because the commodity prices are shot up due to some war, something, or some demand going up somewhere, or some mine closing down, it's neither a plus nor a minus for me.
So having said that, do you see as a forecast margins improving as and these revenues and these sales remaining as robust? I'm trying to understand if FY24 was just one of those lucky years, or you're seeing this momentum for a large company like Maruti sustaining.
I wouldn't like to comment on what margins would be in 24-25. All I can say is that in the areas which are within Maruti's control, we will try and do better this year than we did last year. But what the final result would be, as I said, depends on various factors which we don't or can't control.
Let me just get your sense on the dividend. Of course, investors will be very happy with it. It's a 40% increase in the dividend payout at 125 rupees, the highest ever. What was the thought behind this, Mr. Bhargav?
We have a dividend policy, and this dividend which we have paid out actually comes to 30% of the earnings. We could technically, within that policy, have even given a higher dividend. But one of the considerations we had in determining the dividend amount was that it should be a dividend amount which we can sustain in the future also. Personally, none of us are happy with the idea that you suddenly give a big increase in dividend and the next year you can't give that dividend, you have to come down a little because profit levels have not been at that astronomical level as you had in the previous year. So we have kept ourselves a little flexibility, a little margin, so that we can sustain this 125 in the coming years, irrespective of what happens, at least this happens reasonably in this next year. And that has been one consideration. The second consideration, of course, is that if this itself is a 40% increase in the dividend, and if you give a very big dividend increase, then the shareholder tends to expect that in the coming years something similar will happen, which we may not be able to do at all depending on how the results come out. So we have tried to keep a somewhat balanced, somewhat sober approach to dividend and not gone overboard because profits jumped so much.
All right, there's a longer conversation which you can see later on in the day, and one interesting bit was that Mr. Bhargav sounded a bit circumspect about EVs, but yet says he has to launch one to live up to CAFE norms, etc. Devendra Choksey, just your view on Maruti. Some disappointment perhaps with the margins, but wanted to understand from you, a weak yen, is that a positive for Maruti? Would it be seen in that light, or would the focus be on numbers itself?
Well, I guess I think this particular subject of currency in the Maruti's business, I think, has always disappointed the analysts, I think, from time to time. So I think it is best left to the situation when it probably demands requirement to, I think, look into this. But overall, I think the business portfolio of the company remains absolutely strong and convincing. I think they have found the success with the premiumization of the products. They have found the success with the hybrids, in which they have basically brought in. And probably, I think they have found the success with the higher margins compared to what they were up till now drawing in the smaller models. So all in all put together, and given the fact that I think they want to sustain this particular dividend payout ratio that they have clearly stated, I believe that I think the company probably remains on a stronger wicket. There might be a situation in quarter to quarter where I think the currency impact may be slightly negative on the books of the company. But overall, on the business front, I think the company remains absolutely very strongly positioned, largely because of the fact that the new models are driving the business for this particular company. And at the same time, I think the premiumization process that they have carried out is definitely aiding better than expected margins for the company in recent times. So one would remain positive, but everything is in price at this point of time. Maybe the price correction would be the better opportunity to get into the stock at some point of time.
Right. Sudeep, you want to come in on the charts? BSE is looking like a bad opening, at least in pre-open. We're seeing a massive gap down, low circuit on it. Your call on BSE, and while we are at it in terms of earnings, HCL Tech, and if you want to have a go at ICICI Bank.
Absolutely. See, BSC right now, while we are seeing it's like going to open with a 20% downtick closer to 2600, 2650. But overall, I feel this was the same zone now, 2200 and 2500 was the same consolidation zone in which BSE spent a good time between December and March. So I guess not a bad thing for it to consolidate now at this zone, and once again, post some clarity emerges, we could see some price action to rebound from these current lower levels. So I guess 23 to 2600 would act as some kind of a consolidation zone on BSC. And coming to ICICI Bank, we had seen strong numbers there. And also, I feel going forward for ICICI Bank, 1080, 1090 now would act as a strong support where the stock is closed above its consolidation zone of last couple of months. And I feel it's headed much higher, closer to 1170, 1200 in the next couple of weeks.
So pre-open rates have settled. Stocks that need to be focused on, Samina just spoke about BSE, that stock starting off lower. HCL Tech results reaction, are we seeing that? Let's pull that one up. Let's pull up Shakti Pumps up. Let's put Jayaprakash Power Ventures up. HCL Tech is down 4%. Shakti Pumps up 5%. JP Power Ventures should come about. Jayaprakash Power Ventures up about 5%. And Apollo Hospitals on the news flow, as well as Adani Enterprises on the news flow. I think those are the other two. Apollo Hospitals flattish to marginally lower. Adani Enterprises flattish to marginally higher. So watch out for some of these as well. Devin, very quickly, have you looked at Shakti Pumps? Blowout set of numbers, the valuation is not expensive. Does your team track it? Do you have a view here?
So as such, I think we are not tracking the company per se. The recommendation is not around, but I think the view remains absolutely positive. Largely because of the directional call that we have taken. I think most of these companies are in the better position to get higher amount of order inflow and the margin. From a perspective of the green hydrogen is being talked about, where the requirement of the pumps would be particularly high for the electrolyzer process. And that is where I think most of the companies are going to be enjoying significantly large amount of order and the business going forward. Since we are not tracking the company on a full coverage basis, wouldn't be able to comment on the valuation at this point of time for this company. But I think one will look into it in details, I believe.
Okay, watch out for this one. Sudeep, very quickly, we are very close to open, but metals, they've had a really good run. Do you like a Hindalco, Nalco, or some of the others?
Yeah, Niraj, see, within the metal space, while there's been a big upmove in a lot of names, I feel few names such as, Hindalco, Nalco, and NMDC, they top the charts. And all these three stocks, I feel we could be a bit more positive in the coming few sessions. And these could outperform even within the metal index.
Right. Let's talk a bit about BSE. That's the stock of the morning. We've already seen a big hit in pre-market open. What are brokerages saying about it? And what are the house views on this? Mehika is joining us with more.
So basically, SEBI has asked the Bombay Stock Exchange to pay their regulatory fees based on the annual turnover of the company and considering the notional value of contract. Now, post this, it makes the company possibly liable to pay 165 crores based on their calculations. Now, Jefferies has downgraded the stock rating to a hold from a buy with a price target of 2,900, which implies a 10% downside. Now, derivatives make up 40% of BSE's FY 25-26 profit after tax, and the higher fees could hit the EPS by 15 to 18%. Then we have Investec, which has rated the stock into under review from a buy earlier, and the SEBI's directive could lead to the profit before tax to be impacted by 17 to 18% by FY 25 and 26, according to the brokerage. Now, BSE could either offset the impact by taking price hikes or even take a one-time provision of 96.3 crores in FY 24, according to the brokerage. And lastly, we have IFL. They've maintained their buy recommendation on BSE, but the target price for BSE has been cut to 2,550, which implies a 20% downside.
All right. So that's the word on BSE. Fair bit of weakness there. Sudeep, let me come to you for your last calls. And would they focus on anything in the banking space? I want to talk about AU Small Finance Bank for a second and pull that up pre-market as well. Guidelines for small finance banks to transition to universal banks could be a positive for AU Small Finance Banks. Any of these you like, specifically AU?
Yeah, so if you see AU Small Finance Bank, it was in a downtrend, but last few days we've seen the momentum on the downside slightly reducing, and now this news that has just come, I guess that could act as some kind of a positive trigger for this stock. And overall now, till the time the stock holds 600, 610 range, it could head up higher up to 650, 660 on the upside, where there is a gap that was created on 29 Jan. So I guess short term it is a positive, but from a medium term to a long term standpoint, 665 on the upside needs to cross and sustain.
Okay. Well, what else? AMI Organics, I wonder if this 100 crore preferential issue to White Oak Capital has evoked some response. That stock is up 1.5%. SBI Cards has started off lower. Aditya Birla Sun Life AMC could be interesting because the numbers but okay, 33% uptake, PAT up 56%, equity AUM showing an uptake about 1.5%. So yeah, a few names to certainly watch out for. About a minute and a half left. Devin Bhai, before we thank you, but a quick answer there. Telecom, Vodafone, Indus Towers been in focus. Indus Towers second downgrade coming in a few days. Do you like these stocks at lower levels?
No, Niraj, I think we would like to stay focused on the Big Daddy, which is Jio platforms, which is part of Reliance, of course, largely because of the fact that I think we see a larger amount of customers, better amount of execution of the 5G, and at the same time, new use cases coming up across 5 to 6 different verticals for Jio platforms, which could possibly mean that I think going forward, the consumption of data bandwidth would be on a higher side. That's where probably I think the profit margins I think are on a stronger side. I believe that I think slightest improvement even in the ARPU, I think would result into a huge sum of money for the company by way of a profit. So would like to stay with the stronger player at this point of time and allow the portfolio to compound at 20-25% rate in this particular situation, in this company particularly.
Okay. Well, about 30 seconds left. Sudeep, you have 20-second answer. Sudeep, your top call for the day today. 20-second answer.
Lemon Tree, I feel that this has given a big breakout on the upside last few days. A strong momentum the stock has been witnessing, and I feel this stock could do well and could head up higher up to 155 on the upside with 142 as a stop loss.
Okay. Those are the stocks to keep on radar. Devin Bhai, we'll let you go. Thank you so much for taking the time out and being with us and giving us your views. Sudeep, just stay on for one quick opening comment. But here's how the markets are starting off this Monday morning. Truncated week. We're starting off about 1/3% higher. We'll very quickly move on to stocks because I don't think it's as much about the index, to be very honest. The bank Nifty is higher. Let's get the mid cap and small caps, yes, but more importantly, let's get the heat map up on the screen because the indices are okay, about 1/4%. The heat map. And HCL Tech, Apollo Hospitals, the two names start off wobbly. Result reaction as well as the deal reaction because the valuation slightly lower than what the street was working with. So, in fact, Apollo is now the top loser on the index. There is also Bharti pulling back a little, M&M pulling back a little, but the gainers outweigh the losers. A lot of green, which is a great sign. So, let's talk about the gainers. Tech Mahindra double upgrade from Morgan Stanley. The target price increased to, I think, 1450. So, that's doing well. Shriram Finance, the brokerages have been okay, positive. SBI Life brokerages are largely positive. That stock starts off higher as well. NTPC is up about 1.25%. Metals are doing okay because you see JSW Steel and Tata Steel in the green. You don't see the aluminum plays out there. Hindalco is not quite there, just about 0.7%. So the steel stocks are actually doing well. There is strength in ICICI Bank. No major result reaction to ICICI Bank results and no major reaction to Adani Enterprises on closing the deal as well. Adani Port, in fact, is doing slightly better than Adani Enterprises as well. So net on the gainers list, SBI Life, the result reaction plus maybe the commentary that the management has given on the call, if I'm not wrong, that stock, the top gainer, Tech Mahindra, did upgrade. And on the losing side, Apollo Hospitals is now down 5%. So clearly feeling the pinch of the valuation at which the deal has been done, Tamanna.
Absolutely. And HCL Tech very clearly sort of disappointment as far as the numbers are concerned. I'm going to start by talking about what the indices are doing, the broader indices. Let's pull up the small cap and mid cap indices and see if they're faring any better than your front lines. And it's I would say, okie dokie. Nothing too great. Small cap is at least about 0.5% up. So a bit of, I would say, careful trade this morning. But the morning is all about BSE. And this had a huge hit in the pre-open session. I want to see what it's opened at right now. This is a regulatory overhang, if ever there was one. Essentially, they have to give a regulatory fee to SEBI. And SEBI has now come back and said that the calculation of that fee will change and it will be with retrospective effect. Now, what is that bill going to be? Is BSE going to challenge it? We're not clear what happens. We've tried to reach out to the company. They have not agreed to speak with us yet, but we are hoping to. That stock down 16% this morning and continues to hurt. Some of these also, which reflected in the heat map, but SBI Cards is one that I wanted to look at and see how it is doing this morning on the basis of numbers. And here you have seen a bit of a disappointment. SBI Cards about 2.5% down. IDFC First is the other one that I wanted to talk about. IDFC numbers seem broadly okay. Their operating margins was the problem, and that high Opex, along with the guidance which was not up to the street's expectation, is seeing pressure on the stock, about 4% down this morning. Let's pull up Yes Bank as well, and let me see if we can do RBL if possible. But Yes Bank saw positive results. The tie-up with Paytm is the big boost over there as far as Yes Bank is concerned, because their UPI numbers suddenly have gone up phenomenally. So they are beneficiary of, I think, the Paytm blowout. Yes Bank is doing very well. RBL okay on a decent set of numbers, but RBL not as great as Yes Bank. We'll just pull up Yes Bank again for 1 second and just look at the turnaround in the story of that stock and of that bank. From the days where compliance issues and management really plagued them. So 7.5% there. AU Small Finance Bank was the other one I wanted to talk about. We talked about the norms that RBI has laid out, and there's a set of guidelines. As far as those are concerned, AU Small Finance Bank looks like a good bet to actually maybe be on its way to a universal bank. Niraj was talking about Ujjivan Small Finance Bank. So let's just quickly see what's happening with Ujjivan as well, if we can. That's going to be part of the focus as well. So Ujjivan Small Finance Bank also doing pretty decently, I would say, this Monday morning. IREDA is the other one that I would talk about. And that has a sharp show. So what's happened is that it has now got Navratna status. From mini Navratna has graduated to Navratna status. And that stock about 7.5% up. So some interesting pops of green there, Niraj. But I think metals is the runaway story this morning.
Metals have done really well. And some newsmakers along with it. So I'm sure you marked Yes Bank, but since we're talking about banking and since Digant Haria is about to come in, just wanted to mark Yes Bank up about 8% as well. There is traction in Ercon because of the order win. So up about 5% for that stock too, doing okay. Equitas Bank up about 3%. Yep, so those are the set of names. And yes, largely on the large cap end, you could probably see some bit of metal like up playing out as well. Just very quickly, before we get to Digant Haria, are there some key losers? We've marked most of the names. Craftsman Auto starts off 5% lower, so that's one problem. Spark, another 5% lower. And Apollo Hospitals is down as well, about 4.5% in trade. So that's the third one on our radar today. But nevertheless, more conversations, and let's get in. Our guest for the morning, Digant Haria, founder of Green Edge Wealth, joins us right now on the show with his thoughts on multiple things, and starting off with financials. Digant, great having you. Niraj here. Been a while. Thanks so much for taking the time out. How are you seeing the result season shape up for financials, both lending and non-lending? Let's start with those because we've had a weekend packed with some of these financial numbers coming out with their earnings, quarter four earnings.
Yeah, morning Niraj. Good to be here. Good to be here for the first time. So financials, very big sector. A lot of things are happening, but honestly, there is very little happening in the sector. So there's, the RBI keeps coming out with some circulars. There's deposit tightness. There's margin compression across the board. So a lot of things happening, but honestly, there is very little action in the private lenders, if I have to say that. There's some action in PSU, which you will see in the coming weeks as the results come out. Then, you had these small finance banks which have got, RBI has said that they can now convert into a universal banking license. So today there will be some excitement, but see, Niraj, we all know how difficult was it for these guys to transition from MFI to a small finance bank. I think the journey from small finance bank to a universal bank will also be challenging. It would involve more investment, more Opex, and things like that. So, it's not something where you just go out and celebrate today. I think it's still a long journey for these guys, unfortunately.
Digant, there is this whole case or question marks around what is happening with some of the lenders and how they are not necessarily capex proxies, if you will, because corporates are no longer going only to banks for the funding. Now, my question is, because you've looked at multiple these cycles. The last 4 years now, we've had PSU lenders outperform the private lenders, and that scene doesn't seem to be changing if you look at the price action currently. What's your sense about what happens over the next 12 to 24 months?
So I think, Niraj, the simple one-line answer is we'll see the same movie that we saw for the last 2 or 3 years, that PSU banks will continue to outperform the private banks. The reasons are threefold. First is, if we look at the valuations, the top 4 PSU banks trade at an average valuation of 1.5 times price to book. And now they are doing 16% ROEs. They are not the pre-COVID banks where 8-10% ROEs was was what they would report. Now they are doing 16% ROEs. Whereas if you look at the top 4 private banks, they are trading at 2.5 times price to book. So there's a good, 50-60% kind of a catch up. I don't think that the whole catch up will happen, but some part of the valuation gap will get exhausted because, see, in the PSU space, you will see that 12 to 15% growth will start once elections are over, the capex cycle starts, the lending to corporate sector starts. That is where the private sector banks are not very strong. Private sector banks have been very strong in retail lending, but RBI has really punctured that rally, and you will see more and more circulars and actions being coming out of the RBI stable in the coming days. And the last point, Niraj, is a technical one, that in PSU banks, the FIIs can only own up to 20% today. There's an easy chance that in the next term, the government may increase that FII holding limit to 35%. If that happens, there will be a technical buying which will come. Whereas in terms of private sector banks, they're already very, very overowned. So whatever bad things happen in the US, we are all worried about what happens to the US markets, US debt, US economy. I think that has a direct bearing on private banks because FIIs already overown all these private banks. So we've seen that, the setup is quite against the large private sector banks. The setup is clearly in favor of PSU banks. So I think in large banks, we should focus more on PSU banks. In terms of, in other lenders, there are specific opportunities. We can talk about that in the coming questions.
Digant, hi, good morning. Tamanna here, and I really like that line. We've seen this movie before. Let me ask you about a possible sequel where you have a mashup or a matchup between ICICI Bank and HDFC Bank. Both the numbers are out. ICICI Bank over this weekend, on the face of it, seems to do better than HDFC Bank in some parameters. Perhaps the low provisioning helped. How would you compare the two?
Hi, Tamanna, morning. HDFC is at 2.5 times price to book on March 24. ICICI is at 3 times. ICICI is at a good 20% premium to HDFC Bank, and deservingly so, because it has been able to buck this whole last 12 months of some bit of slowdown quite well. HDFC Bank, they had a very big merger to digest. The HDFC Limited merger was never going to be an easy one. I think 4 quarters of pain we've already seen in HDFC Bank. I don't think it is, a bank of this size can easily turn around in the next 2 quarters. Maybe worst is over for HDFC Bank, but it's not like, the best is coming tomorrow itself. The numbers will only start improving slowly and steadily. So I think from an investing point of view, ICICI will continue to do better than HDFC Bank. And from a stock point of view, maybe both will, probably give 10, 12, 13% CAGR if somebody has a slightly longer horizon. The next 6 months, I'm not even sure of that 10, 15, 20% kind of gains in these stocks.
Just one last bit, and I'm going to come back to the small finance bank question. And you answered that saying that, everyone's excited today because the news has come, but who really makes the cut remains to be seen. On a relative basis, from the guidelines that the RBI has put out right now, who seems closest or best placed to really transition to a universal bank? Would you say it's an AU small finance bank or Ujjivan, Equitas, any of these that you like?
I think in my view, Equitas, the design of the bank and the thinking which is there inside the bank, the management's way of approaching, that's closest to what a universal bank can be. So I think Equitas is the one who, if they decide to apply for it and if they get it, they might have the smoothest transition. Ujjivan and AU Bank, they're still very, very dependent on their old, the old strength or old forts, we can call them. Like AU is still very dependent on vehicle finance. Ujjivan is dependent on microfinance. They're not really diversified away as much. But yeah, if you ask me, number one, Equitas, number two, AU Small Finance Bank. These two I will rate as the best probabilities of transitioning eventually to a universal bank.
All right, so that's pretty clear. Equitas number one, AU Small Finance Bank number two, in terms of who is better placed or which bank is better placed to transition to a universal bank. Digant, great to have you on the show, and hope to see you soon again on NDTV Profit. We always love chatting with you. Very, very short break, but on the other side, we have a slew of earnings and managements to talk to. Stay tuned, all of that coming up.
Amongst the biggest results conversations to have this morning is C. Vijay Kumar of HCL Tech. The numbers of Q4 were flattish QOQ. The FY25 guidance is modest, maybe impacted by offshoring in Q1, but it's leading amongst the tier 1 names. CVK, good morning. Thanks so much for taking the time out. Put this into perspective. We know the situation is fluid. How fluid is it? And in such a scenario, how confident are you about the guidance numbers that you've put out, and what's leading to that kind of growth in FY25? Of course, sum up what happened in Q4 for us.
Yeah, good morning, Niraj, and good to talk to you again. Q4 panned out pretty much the way we expected. We expected good growth in our services business, which has grown 3% quarter on quarter. And software business, there was expected seasonality, which also played out. Overall, Q4 in line with our expectations, which helped us achieve 5.4% growth year on year in the services business and 5% overall in the total business. Now, coming to, and all of this we delivered in a difficult environment while maintaining our operating margins. Our client pyramid has improved. We added $300 million clients. We had a TCV booking of $2.3 billion in Q4, almost $10 billion in the entire year. So it's been a very satisfying year, good performance under challenging circumstances. Now getting into next year, we've guided for 3 to 5% growth. Our assumption is the discretionary spending environment would be similar to what it was in 24. And we will continue to win reasonably large deals, some mega deals as well in this year. So our growth momentum continues. Of course, I remain very positive about our growth in the mid to long term. Obviously, when there is a little constraint in discretionary spending, the growth will be modest.
Two questions on that, and I'll come to margins as well. Or actually, maybe can I just start with that? There's two notes that I read this morning talk about the offshoring impact leading to intermediate dips in the margins. You, I believe, guided had to 18 to 19%, which is maybe in line with what you had guided last year as well. Is this a big deal, or is this a one-quarter impact, the offshoring impact?
See, usually when there are large deals and then offshoring happens, there is some impact. It's a normal part of the business profile. There is nothing to worry about. It is all as per the contracted commitments. Okay, and so therefore, despite increments and despite all the business pressures, you believe 18 to 19% is something that is easily, reasonably achievable, never mind what could happen in quarter one. I mean, there are some conversations around how quarter one could see a bit of a dip as well. I mean, see, if you look at our seasonality, it would be somewhat similar. Quarter one is whatever, there'll be a decline and then things pick up. Okay. Two questions, CVK. I spoke to two of your peer sets of around the same size that you are as well. And they had to say that there are two things happening. One, in NA in particular, a lot of clients are expressing uncertainty until the November period of elections is behind them because they do not know which chart to take in terms of expenditure. And two, one of the conversations or both the conversations seem to suggest that while deal wins might be happening, client spends are not necessarily predictable within that period as well. How are you sensing both of these things? What is your opinion on these? See, I think one overall message is discretionary spending remains muted. That's definitely one observation. But our own presence in North America and the verticals and the investments that we've made and the offerings and the big bets that we've taken in different verticals, they're playing out very, very strongly. So if you see our North America growth is the strongest, 6.8% year on year. And some key verticals, largest vertical like financial services has grown 12% year on year. So we are doing very well in North America and in financial services in specific. Okay, and you don't foresee in client conversations this uncertainty or hesitancy around taking a decision on spend until the US election is out of the way? I have not heard of any such conversations. I think the broader discretionary softness remains, and I wouldn't call out anything other than that. Got it. CVK, one more question, just sensing how you think about it. When you look across the world, I mean, the PMI data across multiple geographies seems to be cranking up a bit, which is probably leading to the central banks not going out and cutting rates as well. Is that good news for IT spends in that if per se business activity is looking to shore up rather than come off, soft landing or whatever you call it, could that be net positive for spending? I think so. I mean, eventually if our end clients are doing well and they will continue to invest in various initiatives, which is good for us. Okay. Okay. ER&D quarter 4 showed a bit of a dip. You've taken a meaningful bet out there too. You sounded positive the last time that we spoke. The company's focus entirely on ER&D are also sounding very positive about growth and commentary. Can I hear something from you about that? Yeah, so I think the opportunity landscape is very big, and we have a lot of exposure to the tech vertical. I do think there is good opportunities building up, and we are quite positive about how R&D segment will continue to pan out.
Okay, but could it be industry? I mean, in the sense, could it be vertical leading growth, or that is not something that is possible to say right now?
Right now, we are not giving anything specific to a segment, Niraj. It's overall guidance of 3 to 5%. We'll stay there, and we remain quite positive on R&D.
Okay, fair call. My final question, CVK, and that is on employees and how you manage that, because attrition is possibly a problem of the past, but there's a lot of talk around how not just the employee management, but the offset that you give to other third parties for working, and those costs might actually move up as well. Any thoughts there?
No, I think our subcontracting cost has only come down, and we expect it to come down further. That's really part of our overall plan.
Okay, you don't foresee increase there. Almost everybody else is talking about actually an increase being seen there. You don't foresee that for HCL Tech?
I don't think.
Okay, great. CVK, good talking to you. Thank you so much for taking the time out and speaking to us. All the best for FY25.
Yeah, thank you, Niraj.
Thank you. Thank you for talking to us. And viewers, thanks for tuning in. Continuing with results, strong Q4 for SBI Cards. Net profit jumps 11%. NPAs improve. We caught up with Abhijit Chakraborty, MD and CEO at SBI Cards, to know more about the quarter gone by. Listen in.
Post increase in the risk weight sometime in November 2023, we expected that the rates will be going up a bit for us, impacting our cost of funds. And we have seen that happening in our Q4. It has gone up by around 20 basis points, we see. But then it deteriorating further for us depends on what the rate cuts come in place. All of us know that that has not happened. And we expected that it's going to come soon as per the market estimation. If that is so, then the rates will remain on stable for us. And in case there is any increase due to market impact, marginal increase, we will be able to pass it on to our asset book. So not much of an impact beyond what expected, beyond what we have seen as per expectation after the regulation came.
Sure, sir. And with regard to when does it start to recover, And maybe a timeline vis-a-vis the repo also will help. So is it going to take a quarter post any repo decrease or reduction in the repo rate? Will it take a quarter or two for margins to start to improve? Because now it seems to be that margins have bottomed, according to you.
I won't say the margins have bottomed up because, as I said, everything will depend on how the ecosystem behaves. We are seeing it as stable. If there is any ecosystem impact, it can have an impact on our cost also. But as we go by what happens around us, so we expect that it remains, it should not become very adverse even in the short run or in the medium run. Largely, it will remain stable. And regarding RBI's actions or whatever guidance they give, we would not be able to tell.
Sure, take your point. Okay, understood. I want to switch focus towards outstanding cards and growth in cards. Just from a market share perspective, there's been a bit of a decline FY23 versus FY24. Is that also largely to do with how unsecured is behaving, how the asset book is behaving? Is that a strategic call to try and reduce or try and curb down on growth and focus on existing customers? Or do you believe that this is a point of concern?
So we have grown during the year by 4.4 million new accounts. Now, that is significant. Yes, we could have grown a bit more, but then January 2023 onwards, when we saw there is a bit stress in the portfolio because of the ecosystem impact, we did take some corrective actions. We did take some decisions which had an impact on our acquisition strategies also. So all these taken together, this might have restricted some incremental acquisition, but then even after those corrective actions, we have still done 4.4 million cards, and this is what we will continue. We will continue to add 1 to 1.1 million cards every quarter, and based on what is our acquisition framework, within that, whatever applications we get and we find it acceptable, we will definitely take them up, and in that process, if the count goes up, we will welcome it.
Okay, understood. So this kind of a run rate clip kind of will continue. Point taken. And with regard to credit costs itself, what's the kind of visibility and where's the pressure coming from in your view? How are revolver rates evolving? And for how long do you expect this pressure to continue with regard to credit costs?
We had analyzed the portfolio around 2 to 3 quarters early itself during the previous year. And based on that, based on our algorithms and customer behavior, profiling, and most important, offers behavior, we had analyzed each and every account, and that's where we found that there will be a probability of some of the customers not being able to pay us on time. And that's where we had given a guidance on what can be the credit cost like in the near term, in the coming few quarters. We had stated in the previous call also. We find that prevailing. Our estimations have stood in place, and during the year, we expect it to taper down. And that is largely going to happen with our new acquisitions for last 1 year have been behaving much better compared to the peers in 21 and previous years, 21 and 22. So once the mix improves, definitely it's going to give benefit to us. But since the current levels are going to continue for the short run, overall during financial year 25, we expect that it should remain above the indicative levels of around 7% and above we have stated.
Okay, so that pressure to continue. With regard to Opex itself, it's tapered in Q4. Is this seasonality, or can we expect this as the revised base from where Opex will largely flatten? What should the expectation on Opex therefore be?
The Opex and specifically the indicator cost to income is partly due to the seasonality because we had the festive season in Q3 where typically the cost goes up for us, and in the subsequent quarter it tapers a bit. And additionally, the corporate book which we had constructed based on the RBI guidelines that came in February, so to that extent also our cost part got reduced. So as we built up our corporate book again, the cost will be increasing, and it will stabilize around the previous levels of around 56 to 57% of the cost income ratio that we continue.
That's SBI Cards, and the stock down about 3.5% in trade. By the way, it's a day that is punctuated by losers, even if the market is higher. And the reason I say this is this. Apollo Hospitals did a deal lower than what the street estimated. The stock is down 8% in trade. IDFC is down 6%. MCX is seeing the follow-on impact of what happened to BSC. And that stock, MCX will come up, is down about 5.5% as well. There is weakness in HCL Tech because of the numbers, down about 5%. There is weakness in Craftsman, led down by numbers, down 4.5%. Mahindra Life, weakness in numbers, 4.5%. We already marked SBI Cards. Motilal Oswal, a lot of it is treasury income, down about 3%. Not surprised at all. Natco Pharma is down about 2% as well. So do keep an eye out for that too. So a lot of stocks have corrected in the session today, wherein lies the problem. But not to say that there are no gainers. There are gainers. Tech Mahindra, I wonder if it's still higher in trade. Should come up on your screen because there is a double upgrade from Morgan Stanley, excuse me, and that stock is up about 1.5%. Remember, it had a bit of a rally in Friday's session too. Supreme Industries is reacting about 7% higher. Aegis Logistics continues to move up about 6%. Tejas Networks is up another 5% in trade today. After a brief pause in Friday's session, is up in trade. And there is strength in sugar. Balrampur Chini is up about 4%, so do watch out for that. Hudco continues to rise about 3% in trade as well. And Arcon has got a big order, and that stock is up about 3%. Now, IDFC First, post numbers. Let's go across to V. Vaidyanathan. Samina caught up with him.
See, the thing about deposits is that since 5 years since the start of the bank, we have been focused on one thing: to put out great products where customers can have a benefit and they can enjoy the product. Second is we have really focused on customer experience. Like we want to keep hacking customer experience both on the internet, the mobile, the branches, the call center. Every touch point we want to give it customers a super experience. So these two things are really helping the bank. And of course, we become a brand. And becoming a brand is a very momentous occasion in anybody's life. When you're not much known, then you don't get deposits. When you're known and people think of you the right reason, you attract deposits. So we're growing, 40%. Now, to your question, how does it look like for the next year? Well, I say that we want to grow by at least 30% next year on this base of about 2 lakh crores. So we think it's definitely possible.
Right. So Vaidyanathan, 30%, that I think is still going to please the street. I mean, 42% or 30%, I don't think anyone's complaining. But what has led to this push on deposits? Have you repriced your deposits? Is that what has led to you doing much better than some of your other peers? Give me a sense of what is pushing growth at this stage.
I see the last, like I said, 3-4 years, we invested in the brand. And known, if you think of great banks like the well-known big banks, ICICI Bank, HDFC Bank, etc., they are very well known for 25-30 years. So everybody knows them. So our bank was less known. So to build the image of the bank was a very crucial moment to get that kind of deposits, number one. Number two, of course, on interest rates front, actually, incidentally, for the first 5 lakh rupees, we are paying like the street, just for information. We pay up to 3% up to 1 lakh rupees. And above that, we are offering 7%. So, because anyway, we're paying fixed deposit, that kind of rate, we might as well offer it here. But for the first 5 lakhs, we are like just bang on with the street, with the rest of the peer group.
Right. So, Vaidyanathan, credit cost has seen, guidance has seen a hike. You want to talk to me about why and what is driving that?
See, the good thing about a credit cost is quite low. You know, for the segments we played, our credit cost is only 1%, actually 0.9%, 0.97% of the total assets of the bank, or 1.32% of the loan book, which is frankly quite low. And it's been like this. Many people say, guys, listen, your NIM is so high. Can you manage it like this? Well, it has been so like this for 13, 14 years. So we feel that we have a unique specialization in the segments we operate, and particularly in rural India, where we're focusing upon, the asset quality is just so good. Maybe people in rural India just want to pay. They're just more honest or God-fearing, God knows. But rural India repayment is superb.
And I want to talk to you about your costs, your Opex. That is one space that you've guided as well for when the second half of FY25 cost of Opex will come down. How quickly can we see that?
We have said that by Q3, Q4, we've been building this bank, and building the bank meaning we have set up branches. We took it from 200 to 900 branches. ATMs, we took it from 150 to 1,100. So all of these things cost money. We made a really fantastic app. Even an app costs money. So all of these things have been costing money when building it up. But by Q3, Q4, we expect many of the businesses to turn profitable, and therefore we expect Q3, Q4 cost income to come down to the 60s actually.
Right. Mr. Vaidyanathan, I want to talk about margins, and I know a decline there is par for the course, but how much more and for how much longer can we see margins ease?
Margins, we feel we will be able to sustain it, Samina. We don't have a problem with that.
So it's
the nature of a business.
Yeah, so fair to assume that this is the range where you will hold margins at for most part of FY25?
Yes, you should expect that. Right. People should expect it from us.
Vaidyanathan, there are some banks that have gone out and recalibrated their unsecured loan growth. Give me a sense of a mix in terms of secured versus unsecured for IDFC. And are you recalibrating at this stage?
Yes, we are also recalibrating it. We are growing more secured businesses like gold loans, loan against property, or mortgage loans, working capital-backed business financing, property-backed working capital plus business financing. We are doing home loans, etc. Of course, we're growing that. But on the unsecured bit, we have this unsecured retail financing category, which is the area where even RBI raised the risk weights and all that. Our book is about 15% of the book. And we feel it's very moderate. And more than that, anyway, we're moderating. But the important thing is that the NPA on that book is really very low. Our NPA on that book is only 1.55%. I mean, the unsecured book. And our net NPA is 0.38%. And it's all backed by cash flows. And the cash flows meaning when we lend, we look into the bank account of the customer, we see the money customer has, keeps balances of that amount, and then we lend against it the customer.
Right. ROAs, Mr. Vaidyanathan, they haven't moved very much. You want to tell me what sort of guidance are you setting out for yourself on ROAs for FY25?
ROA, frankly, the momentous occasion for the bank came when we moved our ROA to 1% plus. So last year we were 1% plus. So this year also we were 1% plus. And by the way, if you look at large corporations like even large state-owned institutions, etc., who have taken, or even Indian institutions, private institutions have taken like 15, 20 years to get to these numbers, reach there in 5 years or 5.5 years from zero 5 years ago. So even this year, we expect it to be somewhere in the zone, maybe slightly upward bias. But by Q3, Q4, we expect our ROA to open up meaningfully. We expect our cost-to-income ratio to come down. We expect our profitability to touch, let me say, with all the caveats of life, we can say that we expect to go past the 1,000 crore mark in PAT by fourth quarter of this year, probably, beat it by a margin.
Thanks for tuning into Talking Point. I'm your host, Niraj Shah. We've divided Talking Point into two. We're starting off with one of the newsmakers of the day, and that's Apollo Hospitals. Remember, Apollo Hospitals has proposed to infuse equity capital from Advent International at Apollo Healthco level and has to integrate Kimet Private Limited with AHL. Joining me to talk about the transaction is Mr. Krishna Akileshwaran. He's Group CFO of Apollo Hospitals Enterprise. Mr. Akileshwaran, good having you. Thanks for taking the time out. Neeraj here. Good morning. The reaction to this deal, which was much anticipated, seems to be from the assumed valuations for AHL, which is Apollo Healthco, of course, at $1.75 billion, much lower than what analysts estimated the one-year forward valuation to be like. Can you explain, one, the transaction and the valuations at which the transaction has been done, and why have these valuations been taken?
I think I think this is an immediate reaction which has come from the market, and I think we should just respect that for now. But the point is, all the analysts were building in a number of 17,000 to 18,000 crores for the Apollo AHL business. But the way analysts look at it, they look at it as FY26, forward multiple, etc., to come at this number. If you look at the money which is coming in from Advent, which is a reputed private equity player who's coming into the business, it's coming in today. So clearly, money which comes in today, yes, it's coming in today at a valuation of 14,478 crores, so around 15,000 crores. I think, roughly around, 1,500 to 2,000 crores lower than what analysts were expecting. So I guess, and that's in some way we'll have to understand that it was something that they were doing based on FY26 forward, whereas this is money coming in now. So, I think we will clearly see that from now on, as we look at the business, I think it's going to be significantly value accretive to the business. I am not overly concerned about the current stock reaction because, it's a deal which is a bit complex. People are trying to understand and assess what's Kimet going to do, etc. I think it's a normal reaction that the market is having, but we are quite sure that over the next few days, as people understand this transaction better, they will realize that the combined entity that we are putting together is going to be a powerhouse in the pharmacy distribution and omni-channel pharmacy business, which should only be significantly value accretive to the Apollo shareholders at large.
Got it. And okay, so I will take that question as well as the third one about you presenting what the powerhouse entity could be like and why so. But just one question, since you mentioned Kimet as well. One of the notes seemed to suggest that Kimet's valuations, and correct me if I'm wrong here, but have doubled over the last 1 year, despite EBITDA largely being flat and 40% of the revenue coming in from Apollo alone. So has there been, is there a financial methodology by which Kimet has been valued as well? And why is it that there is a discrepancy again between what the street was thinking of, informally otherwise, and what has actually been done?
So 2 points. I think, as you said, one of the reports have carried this, but 9 out of the 10 reports have not had any perspective of valuation at all of Kimet, and they understand this business. Because if you look at Kimet, firstly, Kimet has been meticulously built by the Apollo, the promoter family, over the past 20 years, and that they have acquired 19 significant subsidiaries over time, all of which have been legacy promoters of their own. None of them are related parties. They have been regional players. See, the distribution business itself has to be understood by the market. It's a highly fragmented business. 60,000 odd distributors who have been there. And some of the best distributors are now part of Kimet because that's the way that Kimet has grown with time. So the related party transaction that you are talking of, and the fact that 40% of Kimet gives to supplies to Apollo is primarily because it's the other legacy operators or the legacy partners who have been supplying to Kimet. Kimet, over a period of time, has acquired 51% stake in some of them as part of their business model, which is why, clearly it appears as though, 40% is coming to Apollo. But all of them have been legacy. Point number one. Point number two, to your point of Kimet valuation, if you look at, the closest listed peer, we are at 0.8 times sales. That is what has been valued of Kimet, whereas this is at 1.1 times sales. We are valuing Kimet at, what has the Kimet valuation implies 18 times forward EBITDA. And that's again been valued by Advent clearly basis what they understand of the market. And I think it is all above board. I think we will have to face the one odd report because it is a related party transaction which is coming in. But let me assure you one thing. We will, most of the investors, shareholders who understand us, the FIIs, have all been asking for this to be merged with Apollo because it cleans up the structure. It ensures the related party is completely behind us. And I think we'll have to look forward to what it's going to accrete as value to the shareholders again. So I think, it's unfounded, some of these perspectives of valuation. The broad market understands it, and we are here to answer your questions.
Great. And you're doing that well. So thank you for that. So just one quick follow-up there. So you are saying effectively that the valuation which was ascribed to Kimet 1 year ago, which was maybe 0.4, because the current valuation 0.8 you are saying is reasonable, but it has doubled over the past 1 year, if I'm not wrong.
No, I will have to correct that also. A year back, the valuation, equity value at which some of these minority investors, even before we did this deal, there were minority investors in the minority partners in this, as I said, all of that had to also get folded back into Kimet. Bulk of that has been happening at an equity value of 5,000 plus crores, whereas the current transaction is at 6,400 crores of equity value. So not as though, I think the market has picked this up.
28%. 28%.
So 5,000 to 6,400 crores. And that is over the last 15-month period. And the sector itself has got re-rated. Because clearly, if you look at some of the other transactions in this sector, unorganized to organized is a big play.
and we are the largest in the industry today. The sector has got re-rated also. This is the only perspective. Even today, I am again repeating, the transaction is at least at a 25% discount to the closest peer which is listed in the market.
Yeah, and that I appreciate. I think the only question, and okay, so it's 28% and not 50% based on the 15 months ago. The question mark was only that has the EBITDA stayed stagnant while the valuation has gone up? But okay, that can be, I mean, 1,000 ways to slice and dice. So yeah.
Let me answer that also. See,
okay,
the EBITDA has stayed a bit stagnant only because some of the EBITDAs have got passed on to Apollo Healthco Limited, because if you remember, Apollo Healthco Limited has embarked on this omni-channel pharmacy, that the discounts in Apollo Healthco has also been higher in the omni-channel pharmacy business. So some of the discounts have also got passed on by Kimet here, but some of that is now behind us, because as you know now the discount structure in this online pharmacy has come down to close to 12%. We will see Kimet expanding its margins from here on, and more importantly, continue on its stated 20% growth that we have ahead of it.
Okay. Now, do talk about the powerhouse that you mentioned. What's next? Now that this has been established, yes, it's a strong franchise across multiple touch points as well. What happens next in terms of integration of all of these, and how do we see growth for this entity?
I think, we have already guided. That's the important thing that the market should appreciate and understand. We have already guided that this combined entity, which is Apollo Healthco with Kimet, in 3 years from now, will get, we have guided a 25,000 crores revenue for this combined entity, which will be very large, which is the combination of the omni-channel pharmacy business that Apollo is serving to in Apollo, as well as the outside 65,000 odd pharmacies that it has, and a 7 to 8% EBITDA margin, which means implied EBITDA margin of EBITDA of 1,750 to 2,000 crores is something that we can expect of this in the next 3 years, and we will still, as Apollo, own almost 59.7% of this entity as Apollo shareholders. So I think even if you look at the value uptick that will come because of that, I think the market is overreacting. I think we'll have to leave it at that and hope that with time we are able to deliver to what we have committed.
Yeah, well certainly hope so. Where do you think this largest point of growth will come in? And therefore, I don't know about, excuse me for not knowing whether you're in a silent period or no, but the summation of some of the notes that I've read also speak about the resultant impact of all that you're doing at the Apollo Hospitals Enterprises level and what kind of earnings CAGR comes in out there. Could you maybe talk about both of these, Mr. Akhileshwaran?
So this is Apollo Healthco alone, right?
Yes,
the 25,000 crores is Apollo Healthco alone that we have said in 3 years, which can get to. Apollo Hospitals itself is growing at mid-teens. We have a 10,000 crores hospitals business, which itself is growing at almost around mid-teen levels, and we have guided to margin expansions there. We have already said we are looking at bed additions of 2,000 beds over the next 3 years with 3,000 crores of capital. The capital that is coming now from advent of 2,475 crores. You would also have read that 890 crores out of that actually comes to Apollo Hospitals itself. Because of the slump sale that we had done of the business in the past of the pharmacy distribution business, which also comes back to us, which also helps us on the overall growth trajectory. So this 25,000 crores, the way you should look at it is that clearly the Apollo